On this episode of the Stockscores Market Minutes, I will talk about the importance of trading with expected value in mind. I'll then do my regular weekly market analysis, try and figure out if the strength of the market is going to continue. We'll do a market scan in search of opportunities and look at the day trade of the week on CGC. All right, trading expected value. So in last week's video, I talked about whether it was important to use stops, and it brought up a lot of questions about, well, how can you put a stop at -2 RR, -3 RR? If you want to know a little bit more about what RR is and all that discussion, make sure you check out last week's Market Minutes video. So this week I wanted to sort of respond to some of those questions because I think about this a little differently. I think many traders will look at one trade individually and think about the potential loss on that trade. And what I prefer to do is think about the average loss when I'm wrong versus the average profit when I am right. And this makes a little more sense when we start to understand what it means to trade expected value. The expected value of a trading strategy is the probability of profit multiplied by the average profit per trade, and then we deduct from that the probability of loss times the average loss per trade. So if you have a 70% chance of making $2 and a 30% chance of losing $1, then the expected value is 70 times 20, which is 140, minus 30 times 1, which is 30, for an expected value of 110. And what we want in that is a number that is positive, and the more positive, the better the strategy. Now, in order to calculate these expected values, you need a lot of data. You need to have accumulated data from past trades or testing of a trading strategy, and then you can start to figure out what is the probability of loss, what is the probability of profit, and what are the average profits of that strategy over time. Now, it doesn't guarantee it will be that way in the future, but if you have a large enough sample size and market conditions are relatively normal, then it should work that way. And the result then is that we don't focus on the performance of each trade, we focus on the averages from many trades. And ultimately, we can take risks based on the expected value and the averages from past performance. So what I did is I took the trades that I highlighted in my active live daily trading webinar. If you go to the Stockscores website and look around for Active Live, you'll see a video on how all that works. So what I did is I took Friday's trades, and these are the trades that I identified for my audience in the first half an hour of the day. And you can see them there on screen. We have Vertex, ETM, FOMX, you can see them all there. The entry time is in the fourth column, so 9:32 is 9:32 a.m. And I really just captured those trades that I felt were valid for the opening 30 minutes. Now, if we dig a little deeper, you'll see the reward for risk of those trades at the close. It doesn't mean that you couldn't get out better. Perhaps there was an opportunity to get out of some of these better, but I just took it real simple and calculated the average, or pardon me, the reward for risk at the close. And so essentially what that means when you see a 4.6 is that that trade made 4.6 times risk. So if you risked $100, then you made $461. You can also see the drawdowns and then whether that trade was stopped out. So you can see here on WPRT, it was stopped out at a -1.67 using the methodology that I discussed last week. WPRT actually went down 4.67, but it was stopped out before it got to that loss. Now the important number is this is the average, 0.815 average RR. And then I've got some calculations down here. So the percentage of trades profitable was 55%, not really a great day, but the average profit was 2.2, while the average loss was 0.84. So we had a 45% chance of losing 0.84 and a 55% chance of losing 2.2, and that gave us the expected value of 0.83. Now you might be wondering, why is this number different than this number? Because they actually should be the same, and it's just because of rounding in the calculation, because this percentage profitable isn't exactly 55, it's a little bit less. Doesn't really matter, you get the gist of it. At the end of the day, all of those trades totaled 8.97 RR, which was an $897 profit if we were using $100 of risk per trade. The capital required to do that with margin was $23,000, and that represented a 3.85% return. Now that's not a great return. Often days will get up more like 5%, but still, to make a 3.8% return in a single day is pretty awesome. And I think every day last week was positive. We had a couple days when we were over 5%. I think the worst day was 3.7%. But you know, whether you're using $100 of risk or $50 of risk per trade, if you couldn't use this much capital, for example, you would lower your risk tolerance to say $50, and then you can cut this number in half. That's essentially how we think about this, all right? And if you didn't have a lot of capital, you might not do this trade because it was a lot of capital, or maybe this trade. So, you know, sometimes we will adjust the stocks that we target based on our capital available. At the end of the day, though, what I'm trying to emphasize here is there's a calculation that goes into average profit, average loss, probability of profit, probability of loss. And this is a very simple example because we have a relatively small sample size. There's only 11 trades there. But when I do this for my strategy over a very large number of trades, I'm looking at thousands and thousands of trades to get a really good representation of the performance. And so that's a little sort of response to some of the questions that came up. Yeah, I mean, everyone would like to say I get out at -1, but my strategy actually works better if you don't get out at -1. Generally, it's around -3 or better, but it depends on the chart pattern, and that was the lesson I talked about last week. All right, well, let's get into this week's analysis of the markets, and we'll start off with the S&P 500, as we always do. And this is the weekly chart, and you can see that we are at new highs. We've held that upward trend line. We've broken out from the ascending triangle. That's a pretty positive sign that this market wants to go higher. Now, because we broke out from some volatility, it wouldn't surprise me if we get a little pullback before we go higher. However, when you look at the 30-day, 60-minute chart, you can see that we're in a nice cycle of steadily rising bottoms, and so there's no reason to think that we can't continue higher. And in fact, at the end of the day on Friday, we had a little bump up into the close, and that indicates that the buyers are still in control. And as long as our trend line is intact, I would say stay bullish, both long-term and short-term. Looking at the Russell 2000, which is the small cap stocks, and we have had a nice little rally, and now we are bumping up against resistance that has been hit a number of times this year, and it is pretty normal for the market to stall there. And that's what's happened this past week. We had 5 days of sideways trading. I think we're going to break out. There are a lot of charts in that small cap sector that are really building pretty good patterns. And this group, the small caps, has really been neglected for some time. And I feel like retail investor confidence is getting better, and that will lend itself to a breakout in these small cap stocks. So it hasn't happened yet, but we'll keep an eye on that. That's an important chart to watch going into next week. On to the Canadian markets, and here is the TSX, which also broke to new highs. We had that original breakout back here. We made a little flag pattern. We've broken the flag, and that indicates that this market likely to go higher in the near term. Certainly it's underperforming the US markets right now, and largely because of some weakness in the commodity sectors, but things like oil, we'll talk about in a moment, starting to look better as well. Looking at the the very short-term chart of the TSX, you can see that nice upward trend. So that's a nice bullish upward trend. And I think you have to continue to look for opportunities in this market because the trend is up. All right, now looking at the Canadian venture stocks, the micro-cap stocks, and you can see that they are really not participating. They're looking pretty dismal still, but they are also at support from the lows of last December, and that should cause a bounce. I just don't see it yet. But starting to see a little bit of interest coming back to cannabis stocks, as they do look pretty oversold, and perhaps that'll be the catalyst to turn this market around. All right, on to currencies, and we'll start off with the US dollar. We've talked a little bit about the pullback in the US dollar for the last few weeks, but the upward trend line was never broken, and now, in fact, we have bounced off of that upward trend line with a pretty good gain last week. And that should be a sign that the market for the US dollar will continue higher near term. And I'm going to be optimistic on that US dollar until the trend line is broken. Looking at the Canadian dollar, you can see we're going through that bottoming pattern. We've talked about this many weeks in a row now. We broke the downward trend, and we're just kind of building this sideways trading range here. until we can break out through that 75.5, 76 mark on the FXC. I wouldn't get too optimistic, but it is building a pattern of reversal. On to interest rates. The TLT, of course, if this goes down, interest rates go up. It had a bad week last week. What's important though, and I would say the most important thing, is that we have now just about broken that upward trend line. We're right at it, and so we really need to see a bounce next week in the bond market in the US, or it's an indication that perhaps we are going to see a little bit of a rise in interest rates. So again, should bounce this coming week, but let's see if it does. And on to commodities. This is where I want to talk about gold and oil. And with some confidence coming back to the market with China-US trade perhaps looking a little better, you can see a pretty strong sell-off in gold. It had been building this flag. I was wondering if we were going to break to the upside of that flag. Well, we didn't. And so I'm going to sort of knock down my rating a little bit on gold this week. Oil, however, is trying to make a bottom. You can see here the downward trend line, and we're just flirting with it. But what's important is that we're slowly building some rising bottoms. Not aggressively yet, but at least some positive sign that perhaps the oil prices are going to move higher, and that would, of course, be good for energy stocks, which really have not performed all that well this year. And finally, the fear chart, of course, the VXX, an indication of investor fear, and there really is no fear in the market. We are at the lows for this ETN. So then my ratings bullish on both US and Canadian stocks on both time frames. Gold, neutral long-term, bearish short-term this week. Oil, neutral long-term, and bullish short-term this week. Stocks continue to reach toward the all-time highs and moving higher each day, it seems. And while they are due for some profit taking, there's really no sign of weakness yet. Gold has broken down and it should be avoided until there is a show of strength again. Oil is slowly recovering, but still needs to break that long-term downward trend line. And as I said, fear is low. All right, well, let's jump over to the Stockscores market scan and do a market scan. This week, I'm going to run the action break scan. This particular strategy looks for stocks showing abnormal strength against a downward trend. It's a good way to find stocks that are reversing after a lengthy period of weakness. And we're going to run the strategy here. I won't go through all 49 stocks. I'll just give you a quick run through it, and I'll stop if there's any charts that I like. I did go through this just a little bit earlier, and there is a couple that I think are worth considering. What I'm looking for when I see these charts is I want to see stocks breaking their downward trend with really strong abnormal behavior. And what's nice about the market scan tool is I can A, search the market in just seconds, and B, when I see something that I like, click on it, blow it up, and get a better sense of how that chart looks. And so here you can see this stock breaking the downward trend on the daily chart. Well, now I want to take a look at that weekly chart, so I can switch my view to 3-year and click on the weekly, and there I see the problem. It's still below the downward trend on the weekly, and so I don't particularly like that, and I would let this one pass for now. I do think it could get up into that $5.50, $6 range, but I just don't feel like that's enough upside for the risk. No problem. We can continue along and see if there's any other opportunities. Just going to get the next page of the results coming up here. And again, I'm looking for very certain patterns that I know. So this one had some real strength on the daily on Friday. Let's take a look at that 3-year weekly chart. And it's also breaking the 3-year weekly downtrend going back to the middle of 2018. So I like this. I wish it had a bit of a rising bottom, but still I would give this one a 6.5 out of 10. You can see the volume coming in, pretty good price action. I think this has got a pretty decent potential to be higher in the months ahead. We'll do a couple more. There's one in particular that I thought looked really good, and we're going to get to it in just a moment. Montage, that daily chart looks pretty good. Let's take a look at the 3-year. And there, there I see that this downward trend line has not yet been broken, so I don't think it's quite good enough. Here's the one that I like, though. This stock traded huge volume on Friday. You can see on the daily chart coming alive, and you can see the real strong volume spike. And then when I look at that 3-year weekly chart, I also see that it's broken that downward trend. Now, this stock has been absolutely decimated from almost $100 down to, $3 perhaps. And so it's got a lot of ground to recover, but it's a stock that, here it's at $5.88. If it went to $20, it would be a big move percentage-wise, but in the context of that chart, it's not actually that big of a move. And I think that it's something to keep an eye on because it was so strong on Friday. All right, let's jump back into the presentation and get over to the day trade of the week. And this is primarily for educational purposes, just to demonstrate how my day trading strategy works each week. And in this example, we're going to look at one of those cannabis stocks. This is CGC, Canopy Growth. It broke through the previous day's high. That green line that you see on screen was the previous day's high, and it had risen up to the previous day's high, went sideways for a few bars, and then broke out with that action candle right where my mouse is circling, and went for a big move very quickly. So in this case, if you were using a $100 risk tolerance, you would take 900 shares. That's just under $18,000 of capital required. However, you can margin that 3 to 1, so the amount of capital that you have to have is actually only $6,000. It ultimately earned a 13.7 RR return, which is a $1,370 gain for a $6,000 capital investment. That's a 22.8% return for a one-day hold. All right, well, that has been the Stockscores Market Minutes for November 11th, 2019. Happy Remembrance Day. Thanks to all the veterans who have served our respective countries. Have a great week in the market. Make sure you click on that subscribe button, like the video, and leave a comment if you have one. And most importantly, trade well.